Hello, hello, hello. Welcome now, Stock Trade. So, in this video, we're going to go ahead and take some time and just talk about essentially why is the market crashing? Why do we go through these cycles? And when it goes up, it goes up, and when it goes down, it goes down. So, if you understand this, I feel like you're going to understand, I would say, half of the battle of why it's so hard to essentially stay within the market. Okay. So, as always, this is an educational platform. So, we always try to educate, stimulate, and inspire. And if we can go ahead and focus on this, you can see that here is the dotted line of the mean average of the economy. And, there's always these rumors that the economy is not going to continue growing. It's going to essentially basically fall. And, really honestly, that I don't think that's going to happen because as more people get lifted out of poverty, the productivity rate is going to continue. Okay. So let's go ahead and focus in on expansion. So when interest rates are low, many individuals take on a lot of debt. Now, you may ask yourself, why, like, what is debt and how can it be used to borrow the potential energy from the future and input it into today's present value? Well, what ends up happening is a lot of businesses borrow from the future to essentially buy stuff today. And when they do that, they essentially, like, for example, if you were to get a mortgage and buy a house, you borrow from tomorrow, the future, to essentially buy the house today. And that house is going to basically help pay for the developer, the mortgage fees, and all the things necessary to have created that house. Okay. And what ends up happening is after the economy basically starts shifting down and interest rates basically increase, the way the Federal Reserve creates this boom and bust cycles is that once the economic essentially debt cycle becomes very expensive, now we're in a recession, a contraction within the economy. Now it's all about paying your debt off. It's all about free cash flow is essentially, can we got to pay off our debts. And then once all that's done and the economy gets back and put on track, then we get another cycle, another expansion, another business, right? So what is, like, whenever I look at a stock price, like what is it? So stock price normally from a theoretical perspective is equal to the profits multiplied by what investors are willing to pay for it. So the stock price is equal to the profits of the company multiplied by how much investors are willing to pay for it. Now, assuming, let's go ahead and let's talk about profitable companies. Right now, we're in an era where if you look at the PE ratios of companies, they have dropped down significantly. If you look at the price to sales to companies, the revenue multiples of companies, what retail investors are willing to pay for those profits, you can basically see that they are not willing to pay a lot. A lot of investors now, and it's crazy. I speak to so many smart people within their respective fields: lawyers, doctors, engineers, people that are highly educated and leaders within their field, but yet they always listen to headlines. When you listen to headlines in the social news media, the headline is made for you to click. That's what they want. Okay. So there's not really a lot of data in there. Okay. Many folks are saying, I would rather go ahead and wait for a bigger dip. For the big drop. Now, we'll talk about this in the future, but there's something called a likelihood ratio. And if we were to aggregate all of the drops and all of the recessions that we've experienced since 1920, you can see the likelihood of getting towards that bottom or that recession trough. It's very difficult. Okay. And, we'll go ahead. And this is where we get into essentially, the theoretical and the applicable things that other folks that have been in the market do in terms of professionals, right? And again, this channel is all about trying to teach you guys and educate you guys on how the stock market works. Because if you've just started investing, you might like question, like, why are these things going down? Why is Tesla going down? Why are these going down? So right now we're in a contraction. Okay. Many investors are not willing to pay a lot for the profits. Now let's go ahead, and I said the stock price is equal to the profits multiplied by the revenue multiple of how much investors want to pay for it. But guess what? If a company does not have profits, well, then investors don't even want to pay for that. I mean, if you look at Adobe and all these other companies, they have profits, and investors are like, I'm not even going to touch you. I want a lower revenue multiple. And if you have a company right now that, like Clover, that doesn't even have a profit, investors are like, I don't even want to be in the same earth, in the same planet as you. Okay. And this is where we get into a position of opportunity, because now they always say, if you haven't heard this before, that the best time to capitalize on market fluctuations is near recessions, is near contractions, obviously not in business peaks. Many individuals, what ends up happening is they wait the recession, they wait. I hope you're seeing my mouse. They wait. Oh, the stock market's starting to go up. Oh, and all of a sudden, then they go in here and they buy here, and as soon as they buy, it's too late already, and then they're going to start losing money, right? So it's like this. It's like, oh, recession's over. Okay, oh, it's going up again. It must be safe. And they're undervaluing risk, right? So this is kind of the boom and bust cycles that we have. And within this average, we have these smaller little lines oscillating within this average every 3 months through the earnings report. Either earnings is good, earnings is bad, earnings is good, right? But this is GDP. This is not the stock market. But if you were to remove this access, and if you were to put the stock price on here, what you would basically see is something very beautiful that outlines with the economics of the economy. And if this business can take advantage of these expansions and contractions, what you'll see is that if the fundamentals are clear and growing within the company, they will outline with the GDP of the country, respected country in which that company operates in. Okay. So this is essentially, I'm trying to dial back down my videos to just explain a concept, something small, something just if you can understand this, and we keep adding to this, and we'll keep growing with this, right? But by understanding the economic cycle of how things work, interest rates at near zero, interest rates at their highest. I mean, that's a little different. That hasn't happened in 40, plus years, right? So this is essentially where things are at. And there, and the crazy part is, if you were to graph the emotions of investors, unfortunately, I wish we can turn off emotions, but it's very hard. I understand the emotions are all over the place. When investors are near this particular location, they think they're invincible. They think that stocks only go up. They think that anyone who says anything is spreading fear, uncertainty, and doubt. But yet again, when you're down here, many investors think that, oh, stocks can drop another 50%. Stocks can drop all the way down to zero. Oh, and they have these types of thinking. And, I created another channel on our private group here to take screenshots of these comments. And hopefully we'll have a diary of screenshots through the course of time. And we'll outline whether we have an expansion and when we have a contraction on the comments associated with this. And I think that'll be really cool. And then if we have enough data over the years, we can take the words that are used within the expansion and contraction, and we can formulaically generate some data to see, could we predict the bottom? Is there a way based off of the psychology of the market? I think that would be really interesting. Okay. Anywho, this is all I have to say, and I will see you on the next one.